Modern financial systems run on interest. If you are a practicing Muslim navigating this environment, your faith dictates a strict prohibition against it. That creates an immediate collision between your core beliefs and the primary tools used to build wealth in America. For a long time, the conversation stopped there. You either avoided the system entirely or you compromised. Today, the focus has to shift from why you avoid interest to exactly how you can execute a wealth-building strategy despite that restriction. Looking at this map of the United States, you can see illuminated nodes representing a quiet expansion. These markers track viable, active alternatives to interest-based banking operating directly within the U.S. economy. And if we examine the structure of these institutions, this overlay confirms they operate with full regulatory compliance and institutional backing. This is a legitimate sector, not an unregulated workaround. Before interacting with this system, the baseline requirements remain identical to the conventional market. You need a stable income, a healthy credit profile, and savings ready to deploy. Opting out of the financial system is no longer the default requirement. You can participate and you can build an asset base without crossing the lines drawn by your faith. Building wealth requires market participation. Cash savings alone cannot provide the compounding growth needed for long-term liquid assets. This visual demonstrates how an automated, faith-based filter processes that market data. It takes the broad, chaotic exposure of the conventional market and isolates only the pathways that align with ethical investing. Specifically, this mechanism actively removes prohibited sectors from your portfolio. It blocks your money from being invested in industries like alcohol, gambling, and conventional interest-based banks. For a retail investor, the interface looks like this. It scans equities and applies a green checkmark to compliant stocks. By filtering out prohibited elements, you retain full exposure to market growth. You participate in the upside directly. You no longer have to choose between growing a retirement portfolio and maintaining your religious principles. While liquid investments are highly accessible, the largest barrier to Muslim wealth in America remains the real estate gap. This dashboard highlights the exact cost of that barrier over time. On the left, a family remaining outside the market spends $325,000 in unrecoverable rent, while on the right, a homeowner builds $450,000 in personal net worth. This chart isolates what we call the wealth penalty. The flat gray line tracks the stalled net worth of a lifelong renter, diverging sharply from the exponential green curve of a neighbor steadily building home equity. To bridge that gap, the market developed three distinct Islamic finance structures: co-ownership, leasing, and fixed-price trade. Rather than originating an interest-bearing loan, these are based on a gradual buyout, or a defined path to full property title over time. Escaping the rent trap provides the stability needed for generational wealth, and these models offer the bridge required to reach that compounding equity curve. We need to look closely at the limitations of these systems. First, availability is highly tied to geography, meaning these products are not yet accessible in every U.S. zip code. There is also a financial premium. Structuring a compliant product often requires higher upfront fees or results in a slightly higher overall cost compared to a conventional mortgage. These golden scales illustrate the ongoing scholarly debate in this sector. An Islamic label does not guarantee universal agreement or standardized oversight across different institutions. This means you must conduct rigorous due diligence. You are looking for authentic risk-sharing structures, not conventional debt simply masked under a different name. That extra effort and potential premium are the baseline costs for securing a compliant asset. It is the accepted price of keeping your peace of mind intact. Ultimately, the goal of accumulating this wealth is clearly defined. This chart highlights the 2.5% zakat slice, demonstrating that asset growth is not meant for hoarding, but directly funds community relief and future development. If you are ready to begin, step 1 is internal. Assess your personal financial readiness by pulling your credit score and calculating your exact available savings. Step 2 requires local research. Identify and verify which halal home financing providers are actively operating and regulated in your specific state. Finally, step 3 is shown on this checklist. Open a brokerage account with an integrated halal filter, so your liquid assets can begin compounding immediately. The infrastructure is built. The financial tools are regulated and available. The only remaining variable is when you decide to take action.